Good. So yes, we will touch upon what happened in the past 12 months or maybe even 18 months in some cases, looking at Nat Cat. I think you're all aware that we've had much more coming also in terms of wildfires from 2019 and still in 2020. California is literally on fire. Australia had their fair share of bushfires. We've seen hurricanes happening, flooding taking place, even one or the other earthquake. So NatCat was active, and we're not yet through the NatCat season for 2020. So activity on that front. And it's going to be interesting to see how that pattern developed over the years when we take a bit of a larger observation period. Likewise, on the construction front, there have been some construction losses. Were these mega construction losses? I think you heard the definition for mega losses in Simon's presentation before. Here, this is more a reference to some really market record-breaking losses. I think, luckily, and touching wood, we have not seen any of these in this year to date. But there has been a bit of a loss activity also in the construction losses. But then, of course, the big impact and the sort of disruptive factor, I should almost say, would come from COVID-19, has really changed a lot of things and continues to change a lot of things, like, for instance, the way we have to conduct the conferences, or the fact we cannot actually meet face to face. And when we all went for lunch, I could watch Mattia put on his face mask in the office before he was able to or allowed to leave his desk. So really, situation has changed all over the place. And then lastly, we will take a brief look at trends in the energy and infrastructure environment, especially in the post-pandemic situation. If we can take a look also a bit further ahead, what scientists suggest, what the opportunities could be, what the challenges could be, and how we may need to brace ourselves for that, or also ready ourselves for that, because there will also be opportunities, particularly also for engineering endurance. With that, I would like to take first a look at the engineering market, what actually has happened in terms of infrastructure project activity, whilst the more recent months were really hit with COVID-19. I think if we look back 12 months, we've seen good level of activity in terms of infrastructure projects, and we'll just dive in right there and right here. So these are just a few examples of major projects that have hit our desk or have hit the desks of the people in the market, and really taking a little bit of a tour around the clock, basically starting with the top right corner. Dogger Bank offshore wind. It's going to be the world's largest offshore wind farm, happening in 3 phases. First 2 will clock up roughly $4.5 billion US, and the change that we see in that market is that now we're talking about offshore wind much further ashore from those that we have seen in the more recent years. It's almost 200 kilometers from shore in the 3rd phase of this project, so massive undertaking. And it just seems like investment flow hasn't really been affected there, despite COVID-19. The renewable energy sector is still going on. Then next one down, Mozambique LNG project, a project that we saw, I believe, late last year. LNG projects in Mozambique, there's 2 actually out there. This one here, close to $10 billion US contract value, 5 years project, including the entire associated infrastructure and terminals for receiving equipment and exporting goods. Significant project, 2 times 6 million tons per annum of production. And it's interesting to see LNG still happening a little bit, but immediately with COVID-19, a big blow to that particular industry segment, and we will expect to see that only slowly and maybe only partially recovering from that slump in the prospect, which was really significant for the market as a whole initially. Hampton Road Bridge tunnel expansion project in Virginia in the US. challenging subsoil conditions, $3.2 billion project lasting for 6.5 years, infrastructure investment, conventional infrastructure, and particularly in the transport sector taking place. So this is one sector that we haven't really seen a bit of too much of impact. Then another project in the petrochem sector in China, Shandong Yulong Island project development, a refining and petrochem complex, a whopping $14 billion of investment for a 5 years project. That's been up in the market not too long ago. So one of the investments that still have taken place in the petrochem sector. And then moving on to the next one, Red Sea project in the Kingdom of Saudi Arabia, a super duper luxury tourism development project, which is just mind-blowing in terms of features of that project. Close to $5 billion investment, 28,000 square kilometers over a 13 years period, with high-end luxury hotels and apartments, and basically building a number of islands, artificial islands for the high-end tourism, and probably one of the steps that Saudi Arabia has been taking in terms of looking at alternative sources of income once their oil reserves are completely depleted. And then last but not least, Femern Belt Link in Denmark. It's the world's longest immersed tunnel project with close to 18 kilometers linear extension for road and rail operation next to each other, $6 billion, 8.5 years. Whilst it is the longest immersed tunnel project, so record-breaking, it's not actually particularly deep. That's the convenience on this project, right? Here we're talking about some 30 meters below sea level, whereas typically such projects can be easily in the 50, 60 meter below sea level, which would impose different kinds of challenges. Having said that, I still like this project and the complexity and the nature of it, and I've actually a 2-minute video clip that I would like to show and just test how this works now. And we'll see. Yeah, that seems to be coming up. So this is a project from, maybe I just make it full screen. With some 80 modules of precast concrete modules that have to be put in place. The project will actually be going through the construction works from either side of the longitudinal extension. So precast elements lowered into the trench provided by the dredging vessels, and obviously with the entire harbor facilities that need to be installed alongside that on either side of the project. So massive in many respects in terms of volumes and dimensions for this project. And it's going to be an interesting piece of engineering to see how this will actually take shape over the next 6.5 years, I think it is. And of course, as many of these projects, it has been quite a bit debated about its real relevance and impact, environmental impact here. So the topic here in terms of trying to build it in as sustainable a fashion as possible has been a big topic and a big item on the agenda as well. So it will basically result in saving time for travelers from Germany to Denmark and vice versa. And this is what it is. So just a quick test for the video. I can exit that now and go back to the presentation. So now the good news is when we look at okay, now you see it. started to moving again on its own. Okay. The good news is the prospect for the engineering and construction market should actually be quite promising. A study conducted by Oxford Economics and the Global Infrastructure Hub reveals a infrastructure spending gap of in the range of 15 trillion US dollars on a global scale with current trends, and these are pre-COVID-19 trends, delivering something like roughly 80 trillion US dollars, and therefore with the overall requirements or investment needs of 94 trillion US dollars, that's the shortfall that is predicted there. I think what is really eye-catching here is the fact that the numbers that we see for Asia are massive compared to any of the other regions, and in fact bigger than the combination of Europe and the Americas combined. So significant expectation of investment into infrastructure, and that should potentially provide the engineering insurance market with opportunities over the period of 2016 to 2040. How this will actually shape up under the aspect of COVID-19 will be discussion topic at later stage in the presentation, and of course will be of high relevance to all of us on this in this meeting. Looking at where this investment is actually going to go into, then it's a big part that goes into power generation. That will be there, nearly a third. And the question, of course, is going to be what kind of power generation will this be? We'll see a bit of a slide later on about that. Transportation featuring with about a quarter of that. And then, of course, utilities such as water as well, but general infrastructure like airport, ports, rail. So transportation, the main aspect in here. And clocking up to the data here from McKinsey Global Institute, so it's a slightly different time horizon, 2017 to 2035, slightly different to the 16 to 40 observation period on the Oxford Economics study. What is also significant, even having said Asia as the main driver, China on its own is covering for more than a third of this predicted infrastructure spending going forward. And adding up the other Asian markets, I think it will make up for literally half of the entire spending. So big expectation on that front. Now, what does that mean under the current situation? So obviously, when everything looked bright and shiny for the future, all of a sudden we were hit by this virus called COVID-19, and obviously significant impact on infrastructure projects underway already. I think we could really see the wave expanding itself from east towards the Western world. So initially starting in Asia Pac, then slowly hitting Europe, and I think still in full swing in LATAM and also in North Americas. And what we have seen obviously is projects that got delayed or came to a complete halt. I think many disruptions of supply chains caused projects to slow down, inability to travel, shutdown of workshops and manufacturer sites, shutdown of actual construction sites caused a lot of disruption to the industry, and obviously also to the insurance market in an indirect way. At the same time, we've seen commodity prices drop off. I think the oil price was at an all-time low, and this did have an impact on investment decisions that were really taken back and reassessed. That's why the some $50 billion of investment pipeline that was on the radar screen just for the LNG sector itself to really reassess that, and the majority of these projects have been pushed back. Some of them will never actually take place. So a fully fledged global economic crisis has creeped up, and the question is, how long is this going to last, and will there be light at the end of the tunnel? Now, we have a department in Swiss Re that looks at emerging risks, and of course, one of the topics here is, how does COVID-19 affect that? What does it do to the world economy, and how would this have an impact on on somebody like engineering insurers that we are here on the call. So let's just quickly take a look at this clip here. So hopefully it should work just as well. So what the team here does is actually they look at emerging risks, forward-looking, so that we can prepare ourselves on one hand in terms of what it might mean as far as exposure to our book of business and as a company is concerned. On the other hand, what would be evolving clients' needs, and then the insurance need as they emerge in the globe or in the economy and in the markets, and what that would represent for us in terms of opportunities and also considering our own exposure. So clearly climate change, the global lockdown to fight COVID-19 has probably curbed air pollution for people not traveling, but it hasn't actually stopped the global warming, and not in any significant way. So this particular topic, low carbon future, to the need to reduce greenhouse gases remains. And so in order to achieve the expected temperature stability, we would have to save 10 to 20 billion of CO2 tons of CO2 every year. So carbon removal is expected to become a new industry segment that could be as big as the oil and gas industry, and would offer opportunities for insurers, as for instance engineering insurance, just as one of the elements. And of course, this means new technologies may arise that are more shifted towards sustainability. We have seen many more investments or continued investments in the renewable energy sector over the past 18 months, 24 months. So we have not really seen renewable energy cancelled. I can't recall one single project that was cancelled because of the COVID-19 impact. But we have seen this happening in terms of fossil fuel fire projects. And so from that point of view, I think it is fair to say that we can expect a shift towards more sustainable solutions going forward. So there will be other aspects as well. Supply chains is also a topic that have come under attention because of the connectivity that we have with a sort of globalized village nowadays, the impact that the interdependencies that come with it, and on that basis also supply chains will be a topic for the world, but particularly also for the insurance world going forward. Let's take a quick look at what happened in terms of Nat Cat activities. I mentioned that in the executive summary as a first point. So there was a high level of activity with hurricanes, typhoons, and cyclones, starting off with the Hagibis and Faxai typhoons in Japan, with some $9 and $7 billion of insured losses. Hurricane Dorian, that was there, which was one of the strongest hurricanes in 2019 across hitting the North Atlantic season. We've had the cyclones Idai and Fani on one hand, Mozambique, just when they started with the first of the two LNG projects in Mozambique, and then Fani hitting India and Bangladesh. We had massive, absolutely massive wildfires in California still ongoing. I think the predicted insured loss right now, the estimate is in excess of $12 billion and probably still rising. The Australian bushfires, which were devastating, and then maybe not in the traditional sense bushfire, maybe with deforestation activities going on in Brazil, but the Amazonas rainforest is still on fire, and with less control and maybe oversight from the international community, it seems like the rainforest fires have picked up again a bit of momentum in the Amazonas region. Floods were taking place, Mississippi River Basin flood, again hitting 19 to 20 billion US dollars as per predictions. And then in India, monsoon floods, some 10 billion US dollars, China, some 15 billion US dollars. So significant nat cat activity going on, even though 2019 was not the toughest year or the strongest year in terms of nat cat losses. When we take a look at the catastrophic nat cat events of 2019, then this includes nat cat and catastrophic also man-made losses. The total economic losses reached roughly 146 billion US dollars. So a little less than 2018 and below the 10-year average of 212 billion US dollars. But some $137 billion out of these $146 billion emanate from natural catastrophes, whereas only $9 billion US dollars actually represent man-made disasters here. Total insured losses is a fraction of these numbers only. So just maybe a bit more than a third in terms of insured losses caused by nat cat events, and not even half of the economic losses as insured losses on catastrophic losses and nat cat events combined. So good level of activity there, but it also shows that the man-made losses is substantially less compared to the nat cat driven losses. We'll see that in a bit more detail in a minute. Here first we look at the numbers for January to June 2020. So here also already in 2020, whilst we're not yet out of the hurricane season yet, there's been some nat cat activity happening there. With some hailstorms in the northwestern and the northern American region, some tornadoes going on, earthquakes hitting in the Caribbean, and then in Europe, also some winter storm affecting already early in 2020 the market. Floods a bit more in the African and Eastern region or Asian region, plus some cyclones and severe hailstorm activities. So let's take a look at a bit of a longer observation period. When we look at insured versus uninsured catastrophic losses from 1970 to 2019, then, and we're doing so in US billion dollars at 2019 prices, then what we can see is that the trend here, 10-year moving average of insured losses, which is the green curve, and the 10-year moving average of economic losses actually results in a slowly but surely increasing gap. And this is mostly driven due to urbanization activities on one hand, or developments, and clearly also the severity and the trend towards more nat cat losses in the more recent years, which is associated with the global warming and therefore changes in the nat cat patterns. Highly debated topic. Scientists suggest that it's a clear pattern there, and we expect to see this result in further nat cat events. It's also noteworthy that 2019 was actually the second warmest year in history, or since measurements are taken, and in terms of 2010 to 2019, we're looking at the warmest decade on the record. So clearly, global warming showing an impact, and I believe it's fair to say that we see that also in this graph. So the protection gap, whilst for 2019 we have like 86 billion US dollars, so slightly higher than 2018. It's still a little less than 10-year average for comparison, but we're not looking at it just in a snapshot for the year. Overall trend, I think, is pretty unambiguous. So this is insured versus uninsured losses. When we take a drill down on the insured catastrophic losses for the same period, then we can see that about 60 billion US dollars of these insured losses are there. And when we look at how the composition of these pillars in the graph are there, then we can see that mostly, by far the biggest portion is actually weather-related losses. Man-made is small. It's always there, but small, except for maybe 2001. I guess that's a known event to everyone. So World Trade Center, you can see the clue at the bottom there for all of these numbers. But the majority of all these sort of outliers is really driven by significant weather-related catastrophes. You know, if you look at number 5 there, Hurricanes Katrina, Rita, Wilma, significant. Number 7, Japan and New Zealand earthquakes, Thailand floods, and then again number 9, Hurricanes Harvey, Irma, and Maria. And if you look at these 3 pillars, these outliers, they all happened in the last 15 years or so, whereas before it was not anywhere near that number. So quite a telling graph here. And I think just indicating of what I mentioned before, I think we do see a consequence of global warming in these weather-related catastrophes. Now, let's look at the engineering insurance market. We've seen the engineering market in terms of project activity. We've seen now the NatCat impact. Let's look at what the market does. Well, you've seen the rate level index in the interesting presentation of Simon before lunch break. Clearly, the market response to the survey shows that there's an expectation and an observation that rates have started to turn around. I think in terms of dynamics that we have been able to observe in the insurance market, it's clearly we've seen continuation of capacity depletion. Some portfolios went into runoff. Have obviously been severity losses of prior underwriting years, adding to the volatility of performances of various engineering portfolios, including the one of Swiss Re. And this has triggered a right sizing of risk appetite. Many competitors or players in the market have either stepped out of certain industry segments. Some have stepped out entirely of engineering. I think most recently we have seen the headlines about partner Refact team pulling back. And of course also it has triggered a reassessment of capacity deployment. So many companies take smaller shares. Not everybody's deploying capacity to all industry segments or risk types. And when you read, and I'm sure you all do, all these broker reports that you see in the market, then you see one statement which I find interesting, that it's getting more and more difficult to find lead markets. So everybody's kind of sitting a little bit tight, watching what's happening in the market and pushing for best opportunity when the opportunity is right, and obviously pushing hard, which is for what you see on the 4th bullet point, for rate hardening and tightening of terms and conditions. Also, that is very visible in all the broker reports that are out there, market updates that are out there, and you can find that all over the trade media. Clearly, I think the volatility that we have seen, the pattern that we have seen in the past with the loss trends that Simon explained in the previous presentation, what we've seen here with the NatCat losses, and just the behavior in the market from a declining market, as we can see in the years, say, before 2018, have clearly added significant volatility to the market and significant volatility to many of the engineering portfolios in that market. And so I think one topic that seems to be popping up more and more at the senior management level, not just for engineering, but including for engineering, is the need for enhanced portfolio steering measures. And I think that is not a surprise and not new as such, but I think people have just had a good, well, probably a painful kind of reminder why this is relevant and central to the underwriting task and running an engineering portfolio. And I think it's just become a lot more relevant. And I believe it's also fair to say that this has triggered in the IMIA EC our discussions around, what can we do in quantify some of these developments. And I think the task here with the various indicators and analysis of data that we can collect from the market underpin this need for that. And clearly, the reason is self-explanatory, I would say. Reinsurers and insurers have struggled to deliver the return on equity to their shareholders lately. Swiss Re is again a good example for that as well. On one hand, in the more recent state of the market, I think now that we see movements, changes happening, there is prospect for a turnaround on one hand, but at the same time, of course, we have prior year developments with the typical behavior of construction portfolios, and it's important finding that balance right, when to pull the brake, when to accelerate. But unlike, say, in the last soft cycle or really soft cycle, late 90s, I think the financial markets don't offer the prospects for making up shortcomings in underwriting performance, and that's why it's just so blatantly obvious what is required. In terms of M&As and market movements, this is almost a never-ending story in a way. You can read, and I'm sure you will follow all the relevant trade media. You get almost on a daily basis snippets from insurance companies that close a team or pull back from an office or a market, or that undergo restructuring. Probably would go too much into time to go through that in detail. But there are a few things happening. We've seen early last year the Marsh JLT merger take place. Months later, we all heard about the Aon Willis Towers Watson merger coming up, and I think maybe a month ago or so, I believe the shareholders have actually approved that. And I think once all the hurdles are cleared, we will see this taking place presumably sometime early next year. At the same time, and I've just taken one of these snippets here, the capacity changes that are there in the market have a bearing, right? I think by now the general estimate is that more than $1 billion of NPL capacity has been pulled back from the market, from the engineering insurance market, and maybe that's not all yet. So we have to see how that pans out further. I get the message here. Is that okay? You tell me if I'm running over time, right? Okay.
Guido, I think, have additional 2 or 3 minutes, and then we will be behind the schedule.
Okay. All right. Thank you. All right. So I'll accelerate here a bit. Okay. Now, one topic, I mentioned the sustainability topic, and we've seen that from the video clip about the Sonar report, right? I think there has been a sort of a recalibration of how people look at the global economy. And I think we've seen more and more companies pull back from coal, tar sands before, coal now. This is the latest update that we have on that front in terms of insurance companies or reinsurance companies with coal insurance policies, coal divestments that are established with the companies. And I think all major insurance companies and reinsurance companies have taken a position there. Many banks take the same approach. And I think another statement here in the box on the bottom right really leaves coal-fired generators sometimes in challenging situations to just even find insurance capacity because of that. And I think this is just the trend that we will see. There's many more topics that could be continued from there. So if you go back, starting with tar sands, oil sands, some years back, coal, a big topic now. When is other fossil fuels coming up as next? And I think what we've also seen is carbon footprint of companies start becoming a topic at C-suite level. So companies have started to, and banks have been doing that already for a while, but I think insurance companies are following suit, and even some other companies that put the sustainability topic on their forefront of their actions have started to measuring and estimating their CO2 footprint on one hand of the company itself, and on the other hand of the activities they do. And there are measures and methods out there how you could measure the CO2 footprint of your insurance portfolio. And we see that happening. I think not that widespread at this point in time, but I would clearly expect this to take further momentum. So let's swing over to a few loss examples. I keep that simple. I've just taken a snapshot from the Aon Construction Engineering Market Review that came out not too long ago for 2020. And whilst we have not seen those huge record-breaking losses like Hitwango or Inpex, LNG, or also Kuwait National Petroleum Companies claimed there has been a good level of engineering claims, mostly fire-related, I must say, over the past 24 months and also in the more recent period. It's important to mention here that these numbers here, we're not talking about confirmed losses or payments. This is just what is out there in the market and published like this. This is why I decided to just put this screenshot there. But whilst we have seen that cut before, engineering claims still do happen, and we cannot drop our guard on managing these exposures. However, COVID-19 adding a new dimension to the entire discussion. On one hand, you can see here on the right, in terms of all lines of business, the most recent update that has been out there, I think a couple of weeks ago, is about COVID-19 loss and reserve estimates by more than 50 companies. This is just a section from, I think, the top 12 companies in terms of amount, and this is moving towards the $23-25 billion range. We don't know yet, how much actually will be. How this will respond, particularly for engineering market. I think a lot of it is a cancellation of events and other type covers. But for engineering, I believe today, in fact, in the UK, is going to be a bit of a test case to see how FSA will deal with that, and depending on how potential court rulings will come out, this may have an impact on further claims notifications. We will see. But the entire debate, I think, has triggered underwriters, brokers, loss adjusters, I think all stakeholders in the industry, revisiting clauses, understanding, what do they actually mean in a scenario like COVID-19, like a pandemic. It has triggered for sure and continues to do so underwriting considerations. Companies have to take a position on how they want to deal with requests for infectious disease extensions, or how can they protect themselves with maybe exclusions of that. How clear is actual definition of material damage? Is a virus sitting on a surface, is that considered material damage or not? Are there loopholes in a legal environment? What does it mean if cessation of works comes into play and a construction site has to be terminated for a period because of COVID-19 infections? What does it do to supply chain disruptions, concurrent delays? How far does the value chain actually go, and would still contribute to potential DSU exposures? What about the entire non-damage business interruption covers? Questions over questions, none of them simple, even though they look simple, but I think none of them really simple in terms of answering, and I believe it will remain a topic for the insurance market for quite a bit, including engineering insurance. Moving on to future has already started yesterday, trends. I'll keep that pretty short. First of all, sustainability, trends towards renewable energy, more and more. It's undisputed. This has been sort of the prospect from International Energy Agency prior to COVID-19. Actually, our economists predict the insurance market to represent significant additional opportunities post-COVID, because there's going to be a new wave or a new attitude called building back better, with just sustainability being a much more prominent topic in people's minds. But just looking at this stage, right, this is a massive undertaking, still small relative to fossil fuel-fired energy out there, but the growth rates are strong and will provide opportunities for the insurance market overall. If we look at post-COVID scenario, and here again, a proposition put forward by the Swiss Re Institute, their prediction is and this is for EM7, which is the 7 most important emerging markets. I think this is China, India, Indonesia, Mexico, Russia, and Thailand, if I'm not mistaken. For the years 2021 till 2030, the prediction is that this could represent a opportunity in premium of more than 50 billion US dollars in the next decade, around 60% thereof from China. We have seen the relevance of China in actually influencing the infrastructure gap just before COVID-19, and this is not going to be any different, most likely. We'll see about 2/3 in the construction and maybe 1/3 or a bit more than that in the operational phase. And geographical distribution amongst these 7 emerging markets is as per the pie chart there. That's a prediction, obviously, economists' prediction or our scientists' prediction, but it does mean with all the challenges and the hassles that COVID-19 has actually imposed upon us, there is also an opportunity that comes with it. And I think it's there for everyone out there looking at how they or we can position ourselves in being ready for that. Looking a step beyond, usually that's the part when Stefan shows all these fancy video clips with flying robots and robots building construction or doing bricklaying. I will not do that, simply time wouldn't allow it. And I just share with you again a graph which has been in the Swiss Re Sigma about engineering construction markets in 2018. But I don't think the construction industry has changed dramatically, certainly not over the past 12 or say 18 or 24 months. But what we do see here is on one hand that the tech startups are still relatively modest on one hand, but a lot of it is revolving around beam technology. So we see in terms of data gathering analytics on the green sector there, we see design planning software in the purple sector on the sort of center right, and the new construction methods and materials in the top right quadrant, if you want. But almost half of that is really in the amber part of this donut chart, is really related to construction management and BIM activities. That's where we see the biggest activity. That's where we see also new ideas come up. It's probably predominantly happening on that front. Question is, how can augmented reality, Internet of Things, big data, and all these buzzwords have a bearing on that? And if you recall the IMIA meeting in Munich, I think Laura Tönnies presented about how to use modern technology for managing of contractors' planted equipment fleets, for instance. Cyber as the last topic on this one here. This is a bit of a flashback. I think the world hasn't stopped turning to the opposite, rather. If you do see here cyber rates hardening as hackers spot COVID-19 opportunity, I think even in our company we got regular prompts from Swiss Re in our working environment to be more careful about cyber attempts, and I think that's true for everyone. I think for the fact that so many people are now resorted to working remote, obviously creates new opportunities and also from their business perspective, if you like. So without any further ado, I will come to the summary and outlook, keeping it short and sweet. So first of all, I think the impact of pandemic fostering is really fostering a turning point in the insurance market. In an insurance market that has already been in motion, recovering or kind of starting to recover from a situation where severity losses have hit the market, structural changes have taken place in the market. I think COVID-19 is just yet another catalyst to drive things faster and further. And on one hand, with potentially substantial opportunities coming with it, but at the same time also a sort of a regathering and refocusing on more sustainable push forward. So that will be clearly a topic. So sustainability continues to gain momentum further. I believe it's also we are in times of change, and maybe while still looking forward here, I think it's probably not a bad idea to go back to the roots in terms of underwriting, stick to the basics on one hand, and at the same time do it with a more portfolio steering driven mindset in order to just take out that volatility that we have seen hit the global market and probably many of the portfolios of the people represented in this call. Lastly, recovery of the economy, building back better. Yeah, as mentioned, and that's just shown in those pie charts, is most likely representing significant opportunities for engineering, reinsurers and insurers, and of course the entire industry that comes with it, loss adjusters, brokers, everyone, all stakeholders in there. Not last but least, also included or supported with government stimulus packages that we expect to see through recovery attempts from governments to help bring their countries out of a COVID-19 inflicted economic crisis. So I think whilst a lot and a very dynamic environment, I think it's also for us a call to adapt to what is probably going to be the new normal, because COVID will not disappear, that's clear for now, and there may be other developments around the corner that we don't even know yet, so we need to stay agile. With that, I would like to close and thank you for your attention, but open up for questions, which I believe Mike is managing.
Have any
Thank you, Guido.
specific questions? There is a mention from the UK COVID case has come out today, but I think it's probably not clear. Some people are saying it's pro insurers and some people are saying it's pro clients. But there's no other questions from your wide-ranging review, Guido. So shall we go on to, I think we're running quite late. So Richard, can you take up the next introduction to the working group topics? And thank you very much, Guido.
Thank you. And I stop sharing so you can take.
Okay, right, well, look at that, yeah. Yeah.
Okay, well,